The Bank of England bank rate has gone up 4 times over the past 5 months, with inflation at over now nearly 10% and a cost of living crisis. In this video, we'll break down what inflation is, how the Bank of England tried to control it, and what this means for you and your finances in your bank account every single month. So firstly, what is inflation? Well, inflation is simply a measure of the cost of goods and services over time. For example, getting a haircut or buying a train ticket, filling up at the petrol station, buying a loaf of bread. Over time, inflation bumps up these prices. The way inflation is measured is what things cost today versus this time last year, so it spans a 12-month period. To bring this to life and show you how inflation has changed things over time, on the Bank of England website there's a really interesting calculator where if I was to buy a coffee that was £3 this year in 2022, and then I go back to 1960, that same £3 coffee would cost just 18 pence. So how is inflation measured? Well, it's very simple. The Office for National Statistics take 18,000 prices from 700 items every single month. They essentially use this as a super huge shopping basket to work out the price of goods now compared to the price of goods last month. And over time, they start to work out what the annual inflation is. So that massive basket that they create costs X amount more this year than what it did last year, and that's how they get inflation, which is measured based on the Consumer Price Index. As you can see on this graph here, over time inflation has gone both up and down, and there's been some interesting major events. So back in the late 80s, inflation and therefore the Bank of England rate was both very, very high. Then into the 90s, things started to calm down and stayed anywhere between 1 to 3% over the course of the early noughties. Now, going into just before the global financial crisis back in 2008, you can see the interest rates went as high as 5.2% before very, very quickly crashing down during the financial crisis of 2008 into 2009. Since then, it was a little bit wobbly and it's gone back up to as high as 5% back in 2011. And then going into more recent times, we had another dip during the pandemic, and that changed the way that markets were working. Since everything has been opened back up again, markets are trading, imports and exports are going back to normal levels, there's still some restriction on supplies, and that's causing everything to shoot up in price, which is why we're now seeing inflation of around 5% at the end of last year and now going up to 7 to 10%. So there is something known as the government 2% target. Now, the government set the Bank of England a 2% inflation target rate every single year. So it's the Bank of England's job to get as close to 2% as possible by controlling the economy, the amount of money they print, but most importantly, and one of their biggest levers to impact this is the Bank of England bank rate. The reason why 2% is a really important figure is because it's a nice number where things are still growing, the economy is getting bigger, but it allows people to plan and aim towards based off that particular figure. But on the other side of that, if inflation is too low, then people might hang off from spending because they think prices are going to keep continuing to go down. Thus, again, in that scenario, the economy starts to shrink. So basically, either way, you're damned if you do and you're damned if you don't with inflation. If it's too high, it's bad. If it's too low, it's bad. So it has to be in the sweet spot in the middle. So what happens if the Bank of England don't meet the 2% inflation target? Well, the main thing that happens is that the governor of the Bank of England will then send a letter to the Chancellor of the Exchequer in the government explaining what's happening, why it's happening, and what they're going to do to try and bring inflation back down to normal levels. This happens when it's above 3% or below 1%, where you start to see extreme inflation in both directions. And you can actually read the letters that are sent from the governor of the Bank of England to the Chancellor of the Exchequer and see what they're explaining in terms of their rationale. Why is all of this happening? After the Chancellor of the Exchequer receives the letter, they will then respond back to the governor of the Bank of England, explaining whether they agree, disagree, and talking about factors in the economy that they're seeing as well, and whether they agree or disagree on the whole situation. So will inflation keep rising? Now, this is a really tricky question, and clearly it's hard because the Bank of England keep changing their forecasts. It really is like predicting the weather. It's quite difficult. You can see a little bit in advance, but it's hard to see very far into the future. We had no idea at the very start of this year that Russia would invade Ukraine. That was never planned into any of the forecasts, but we did know that after COVID, markets were opening, but there was still a big restriction on supply and demand, thus causing prices to go up. You then enter the Ukraine-Russia situation, completely unexpected, but that means now that Ukraine being a big exporter of grains and lots of different products, there's a big restraint in the market, which means there's less supply available, but still the same amount of demand, which again pushes up prices, meaning we're victims of higher inflation. So how high will inflation go? Well, at the moment, it's officially announced at around 7% on the Bank of England website. But in reality, there's a lag in this timescale. It's more likely now to be around 9 to 10%. And the forecasts of the Bank of England also predict that inflation is going to be around 10%, if not a little bit more later into this year. I personally think it's going to go a little bit higher, which means that we can expect the Bank of England bank rate to continue creeping up over time. I don't think it will go as high as the 90s and the 80s when it was almost 13 to 15%, but we'll definitely see it creep above 1% now we've hit that 1% threshold. So we've covered inflation and what inflation is. So now let's move on to the Bank of England bank rate and let's look at how this controls and helps inflation in the economy. The reality is the Bank of England can't control supply and demand chains across the entire world. It's not something that they can help or ease or do anything about. Supply and demand is supply and demand. But the one big superpower that the Bank of England have is changing the base rate, which is known as the Bank of England bank rate, which is what affects everyone's mortgages, loans, credit cards, and also savings accounts as well. It's something that banks look at very, very closely. Raising the interest rates makes borrowing through mortgages and loans less attractive and encourages more people to save, which means they're spending less, which then starts to bring down the price of goods. Likewise, if they brought the interest rate down, it makes lending more attractive. People want to take on bigger mortgages because it's cheaper, but then at the same time, it makes saving less attractive and therefore people spend more, which then starts to raise inflation. So depending which way the economy is going, the Bank of England will either increase the rate or decrease the rate to try and control the amount of spending that we do within the economy. So what's the history of the Bank of England bank rate? Well, over the past 30 to 40 years, it really has been both up and down. In the 80s, it was as high as 15% to control spiraling oil costs, wages shooting up, and all of the economy booming after the war. And more recently, since COVID also took hold, as low as 0.1%, which is great if you have a variable or a base rate mortgage because it means that you are paying minimal amounts of interest, but it also means that we gain nothing in our savings accounts. So why does the bank rate influence spending and saving? Well, the reality is when interest rates are low and it's harder to get more for your money in a bank account, it means that the value of wealth is worth a lot more because people look towards property and pensions and investments to keep growing their wealth because it's harder to grow your wealth. Whereas when interest rates were as high as they were in the 80s at 15%, the value of wealth becomes less because people could have their money sat in a bank account and it still gains 15% every single year just through interest, thus devaluing total wealth. Which is why in the 2008 economic crisis, interest rates plummeted really down to the bottom because it discouraged saving and encouraged spending and borrowing to get the economy going and trying to keep some form of positive growth at the time where the economy is shrinking. So my favourite bit, will it impact property and the housing market in the UK? Well, this is always a big question. Lots of people love to talk about it. The reality is over the past few years, especially since the pandemic and the boom and the artificial inflation that we've had in the property market after the stamp duty holiday, house prices have been completely skyrocketing. It is a bonkers market right now. Both the Bank of England and the government are watching this very, very carefully. What they believe, and I think is reasonably true, that because it's so hot at the moment, it's like bubbling a pot on the hob. It needs to cool down at some point. So they believe because of the cost of living crisis, increased fuel, increased costs happening this year, that will start to cool the temperature of the property market, but it's still overall going to be a very hot and very competitive market. And if you follow the 18-year property cycle, at the moment we're in the explosive phase. So we've gone through the recession, we've gone through the recovery, we've had the mid-cycle wobble during COVID, and then now we're entering the explosive phase where we'll see for the next few years house prices continue to hit record-breaking levels until at some point around 2026 we'll start to see the market have some form of correction. This is a financial model that's been talked about for many years and looks at history going back over 200 years where the property market is somewhat cyclical and happens again and again in that same format. So what's next for the Bank of England rate and inflation? Well, nobody really knows, but the Bank of England believe at the moment that inflation will top out at about 10% this year before going back down all the way to 2% next year. Now, I don't massively agree with the last bit of that. They keep changing their forecasts, and I think with the reality of the Ukraine and the Russia situation, the problem is even if the war stopped tomorrow, there are still going to be supply issues from a Ukraine perspective because they don't have the crops and the fields to export all the grains and different products that they have within the country. So that's still going to remain an issue for the global food markets. You've then also got the European Union, who recently announced that they do not want to buy any more Russian gas and oil by the end of this year, which means that everybody in Europe is going to be in a more competitive market with less supply from other countries, which thus is going to increase the prices and still keep inflation high. And with COVID really impacting China again at the moment, having very, very strict lockdowns, this means at the moment there's a real squeeze and restriction on exports out of China, which again is going to increase the cost of goods on top of all of that. So I think we're in for a very, very tricky year. House prices are going to continue, but also the gas bills, electric, all of that will go up towards the end of this year when the new Ofgem price cap raises again. So it's going to be a tough year. Inflation, I think, will stay high at least for the next year, and thus the Bank of England will need to keep continuing to increase their Bank of England rates. The best thing you can do is just keep saving, building up your wealth, and I always strongly recommend investing into the stock market so that your money can grow beyond inflation, which is why this video here is really important if you want to learn how to get started in stocks and shares and open your very first ISA to start investing through an easy platform just like Vanguard. So click on this video here, and I will see you in the next video.